Welcome to The Income Generation, the show where we provide information for the critical period in people's lives, that period when they're in or approaching retirement. The information you get here each week is designed to help you discover ways to think about the markets that could serve to make your retirement journey much simpler. I'm David Scranton, your host. I enjoy this opportunity each Sunday to share with you the insight and expertise that I use in my own investment management practice. I'm quite sure today's show will be insightful and hopefully provide ideas to improve your family's retirement investment plan. Today, we'll talk about what's happened in the past when the economy or the markets have been in a similar position to where they are now. We'll also talk about people who share their expectations or market warnings based upon their own research in the past. I look forward to pointing out some of the people who have gotten it right. Wouldn't it be nice to have a crystal ball or a time-traveling DeLorean for that matter? It would take you forward in time, you could read a newspaper, and then you know if you should be in the markets today. Or you'd know more specifically which investments will do well and which ones will do poorly. That's a nice dream. And since we're dreaming, let me give you some advice. If you find yourself temporarily in the future, take down the winning lottery numbers instead. Historically, they've always paid winners a much higher return than the financial markets do. Okay, back to reality. And the reality is that no one can predict future stock market levels at a particular date and time. But the market does have a past, which we can now look to determine likely future trends. In fact, throughout history, we've had recurring patterns in the market and the economy, some so regular that if they follow any direction other than that which they have in the past, well, they could go into the Guinness Book of World Records. And it's part of what we'll discuss today. We'll look at different ways to measure the market, the direction it typically moves when certain events occur, and what one can deduce from it. Later in the show, I'll sit down to discuss the current state of the economy and the markets when I go one-on-one with Peter Schiff. Peter is a world-renowned economic forecaster. As a host of the popular radio program, The Peter Schiff Show, as well as CEO and Chief Global Strategist of Euro-Pacific Capital, he's one of the few forecasters who accurately, and what's more importantly, publicly predicted the 2007 housing market collapse, as well as the subsequent 2008 financial crisis. Today's convergence of events, statistics, and timing could not have come at a better time for this discussion, so make sure you don't go anywhere. Marty Johnson will also be back again this week with her report. Each week, Marty helps us fill in many of the questions people have with what she calls her news and views. This week, she's going to give a little bit of a rundown on past predictions about the markets and economy. She'll look at who's called it right and perhaps who's gotten it wrong. It'll be interesting for everyone, especially me, since some of these forecasters have been guests here on The Income Generation. One of the questions I'm frequently asked by my clients of Sound Income Strategies is the following. Can we expect the economic recovery to continue? Of course, they also ask my view of the stock market. This shouldn't be surprising since the stock market hasn't really gone anywhere lately. The S&P 500 finished 2015 at just about the same levels where it began the year. Although it did have a few slow climbs throughout the year, they were, without warning, followed by abrupt drops. In my opinion, I tell them, staying in the market now when the market is near its record high, after nearly a 7-year rally, probably isn't the most prudent idea. The reason is because from 2000 to 2013, the market had zero growth, accompanied with two major market drops in the middle of approximately 50% each. As a result, all the price growth that occurred this century has happened since 2013. So the question is this a permanent recovery or a temporary government-induced recovery? As it turns out, historically speaking, if it were a permanent recovery, we'd be breaking not one, but 3 unlikely world records with regard to the stock market. First, it would actually be the first time that the stock market recovered from what we call a secular bear market in only 13 years. That's never happened before. Second, it would be the first time it's recovered without a third or greater major drop. Thus, the reason for my thoughts that it might just be the right time to see this drop in the year 2016. And lastly, it would be the first time the stock market has recovered without price-to-earnings ratios getting down into the mid-single digits. Now, records in general are rarely broken, and 3 at the same time would be highly improbable. For those who are tuned in to my show on December 20th with Harry Dent, you know this already. Marty Johnson gave a report on stock market history which explains that the stock market historically seems to go through a complete cycle. It rises for a period of about 10 to 15 years in what we call a secular bull market. The rise is then followed by a secular bear market, typically of 20 years or more. The whole cycle lasts about 35 years. But within those 20-year plus bear market periods, there are good times and bad times that all negate each other, resulting in, you got it, zero growth. Now we're at the 16-year point, and we've had a larger than normal upwave, thanks in large part to quantitative easing. The question is, could we be at the turning point for that expected third wave down, what I call the phase of capitulation? Well, not only has every bear market throughout history had at least a third major drop, but often each drop gets sequentially larger than the previous. Now, to put this in perspective, for the next drop to simply match the previous, the magnitude of that drop would have to be 65%. A 65% downturn from where we are today based upon the Standard & Poor's 500. In this case, although history says it's very, very possible, I will tell you that the last drop was so large that I wouldn't necessarily hang my hat on the idea that the next one will be even bigger than that. But it is quite possible. However, for history to repeat itself as it has throughout the past, we would indeed have to incur at least a 30% drop from today's levels to break below the resistance levels, or what I call previous market ceilings from the years 2000 as well as 2007, before both of the previous major drops. The bottom line is that even a drop of the magnitude of 30% or greater would be detrimental to you, members of the income generation. If we don't have a historical drop soon, we will have gone against market history and broken historical norms. Now, another reason I think the time could be right now for that third drop is because the NASDAQ has just very recently reached its previous record level. Some naysayers back in 2007 wondered if this time it's going to be different and these cycles simply would not repeat themselves. Why? Because the Dow at that time in 2007 had gone some 20% over its levels from 2000, right before the tech bubble burst. However, what they missed was that the S&P 500 was lagging and had barely reached its 2000 levels by 2007. Only then, when both indices were at or above 2000 levels, did that second drop begin. Since 2013, this time the S&P and the Dow have both surpassed their levels from 2000 and 2007. The naysayers, of course, are at it again, saying that, well, maybe this time it's different. This time, however, what I believe they missed was that the third index, the NASDAQ, until very, very recently, has been lagging. Again, I believe that now, with all three indices at or near their record high levels, we very well could be poised to see that third major stock market drop. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. As this show airs, we're just entering year 17 of the long-term secular bear market cycle that started back in the year 2000. From 2000 to 2013, the market experienced zero growth, as I said a moment ago. Since 2013, however, it's gone up dramatically. With quantitative easing as the driving force, the markets have not only surpassed their previous peaks, but set new record highs. The Fed's artificial trickery has managed to keep the current cyclical bull rally going for much longer than normal. There's certainly no denying that. So why should you be concerned? Why am I concerned for you if you have a lot of your retirement savings in stocks right now? Well, it's because I also cannot deny the realities of stock market history. And those realities, combined with a lot of compelling current economic data, suggest two things. One, that a third major drop is still on the way, despite all the Fed's trickery, or economic alchemy, as I called it last week. And two, that this drop could very well be even worse than the drops that began in the year 2000 and in 2007. And by worse, I mean it can be steeper, bigger, and more devastating for everyday investors whose portfolios are heavy on stocks and stock mutual funds. I base this on hard numbers, and there's actually a logical explanation for it. If you look at a stock market chart from the last 16 years, basically you'll see a big W. But what you'll notice is that the second half of the W slants down further than the first half. The bottom point is actually lower. Obviously, that's because the market drop that occurred from 2007 to 2009 was bigger than the one from 2000 to 2003. In the first drop, that which was triggered by the bursting of the dot-com bubble, the Standard & Poor's 500 fell by 49.1%. In the second, triggered in part by the housing market collapse and the financial crisis, the S&P plunged 56.4%. Scary numbers, I know, but not surprising if you know your history. In fact, if you take a stock market chart from 1966 to 1982, and you overlay it over what we see from the last 16 years, the time frame might look different, but the big W will look very, very similar. You'll see that its second half slants down further than the first. What you'll also see, however, is that there's another V attached to the W. And you'll notice that it slants down even further. That means its bottom point is even lower than the second half of the W. That V indicates the third and largest stock market drop of the 66 to 82 secular bear market cycle. The fact is, throughout history, most of the major drops that have occurred within long-term secular bear market cycles have had two things in common. Each has occurred only after the market has approached or surpassed its previous peak. Also, each has been progressively larger than the previous drop. So think about these market patterns as waves on an ocean. If you were an experienced surfer, you might know to wait for that third wave to paddle out. You would know based upon your experience that the third wave was going to be the largest. Of course, knowing that as an investor instead of a surfer is a whole different story because you don't want to catch that third wave. You want to avoid it if at all possible. Either way, however, it's good to know it's coming. As I said, there's a logical explanation behind this pattern. There's a reason these waves get bigger and more devastating for buy and hold investors. It's because they're what I call waves of capitulation. Oftentimes they indicate who is getting out of the market en masse and when. To see the logic, think about it wave by wave or drop by drop. The first one always occurs after a prolonged period of market growth, what we call a long-term secular bull market cycle, much like the one that ended in the year 2000. When that first drop occurs, Wall Street and a lot of brokers and advisors offer their usual advice. They say, hang in there. You can't time the market, and the market always comes back. Many small investors who've been hurt by that first drop try hard to take that advice. especially those who aren't familiar with secular market cycles. Other small investors, however, capitulate only because they simply cannot afford to stay. They're afraid of being wiped out. And you'll see that's the whole point behind these waves get progressively bigger. It's because bigger and bigger accounts have more staying power when the market drops. They simply don't capitulate until later. And as they do, that causes a steeper and steeper drop. But now let's look at wave number 2. The market rebounds from the first drop. It approaches or surpasses its previous peak. And then another tipping point occurs. Caused by what, you ask? Well, it really doesn't matter. It could be caused by some piece of global or domestic bad news that would barely cause a blip in the markets during a long-term bull cycle, but in a secular bear cycle, it triggers that second major drop. This time, though, a lot more time has passed, and a lot more investors have grown frustrated by their losses or lack of gains in their portfolios. A larger number of them, including many with larger accounts this time, sell into the second drop. With more money selling into the second drop, that drop ends up being bigger than the first. But then again, the market recovers. It approaches or surpasses its previous peak, and along comes the next tipping point. It could be a bleak new economic report or some major new terrorist threat abroad. By this time, even some of the most patient and stalwart investors give in to frustration, and they capitulate. By this time, they usually consist of the very biggest investors with the deepest pockets. They're the ones who could most afford to hang in there through the first 2 drops. Unfortunately, once they start selling into the third drop, it winds up being even bigger than the previous 2. Again, the bottom line here is that people with bigger and bigger accounts have more staying power. The fact that they are willing and able to ride waves longer is what makes waves, and these waves of capitulation, in a secular bear market cycle, oftentimes progressively larger. In fact, I always say we simply cannot recover from a secular bear market until all the people who are going to sell actually sell. Again, unfortunately, small investors who make the choice to hang in there through all 3 drops tend to suffer the most when the third one hits. That's when they realize they've endured 20+ years of stressful wave riding to end up with 0 growth in their stock portfolio. Or in fact, less than 0 when you factor in inflation.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
I'd like to welcome to the show Peter Schiff, who is a world-renowned economic forecaster, host of a popular radio program called The Peter Schiff Show, and CEO and Chief Global Strategist of Euro-Pacific Capital. Peter, welcome.
Well, thanks for having me on the show.
So I want to ask you several questions today. The first of which is, of course, relevant to interest rates. My concern that I have with interest rates is that if the Federal Reserve raises short-term rates too much, and long-term rates are being artificially suppressed by what's going on abroad, then we flatten out the yield curve, which causes a stall in the economy. But what if I'm wrong? What if long-term rates actually do increase as a result of the Fed's moves? You know, what'll that do to mortgage rates? Could it possibly create another housing crash like we had back in 2008? What's your take on that?
Well, there's a lot to your question there. But first of all, you know, interest rates have been too low for too long. That is the problem. And the Fed needs to allow the market to set interest rates. And I believe if the market did set interest rates, they would be much higher than they are today.
Of course, yeah.
And of course, by the Fed keeping interest rates so artificially low for so long, not just at the long run, and they've suppressed long-term interest rates with their asset buying, you know, the quantitative easing, but also keeping short-term interest rates so low, they've distorted the economy. And what we've had ever since the last financial crisis was not a recovery, but a bubble. And you know, we haven't
artificially created, exactly.
Yeah, we haven't addressed any of the structural problems caused by the last bubble. We simply compounded them with a new bubble. So all the Fed has bought with all this quantitative easing and 0% interest rates, it is a huge speculative bubble. We have inflated our asset prices and we've gone deeper into debt, but the underlying structure of our economy it's actually gotten worse.
Yeah.
So I think fundamentally we're in worse shape now than on the eve of the last financial crisis, which is why the next financial crisis is going to be much worse. And I think it's going to be a currency crisis and a sovereign debt crisis too.
Okay, so yes, you do believe that that could affect housing adversely in even a worse way than it did back in 2008.
Well, it depends on your perspective. If you want to buy a house, it's going to be a positive development to see the prices collapse. See, the problem with housing prices is they're still too high, and most Americans can't afford to buy these high prices. In fact, if you look at the home ownership rate right now, it's the lowest in nearly 50 years. And many Americans who would like to buy homes who can't afford it are renting. And if you look at rents, rents have been rising very sharply for the last several years. And now we have people spending record percentages of their income. I think now something like half renters are devoting half their income to their rent.
Just the rent, which is kind of crazy.
Yeah, and so what the solution is lower housing prices, but the government is standing in the way by artificially propping them up with cheap money, government guaranteed mortgage rates, 3% down payments. And of course, a lot of the houses now are owned by speculators. They're owned by hedge funds, private equity companies that have bought up all these homes and they're renting them out. But that's all artificial demand generated by the Fed. So I think when this bubble pops, real estate prices are going to come crashing down again. That's going to be a big problem for the banks that have mortgages. But for people who have been struggling, who want to buy a house,
it's an opportunity. Yeah,
it means that the homes will be a lot more affordable.
And I think you're preaching to the choir a bit with our income generation viewers who are concerned about, they share the same concerns that you and I both have. You mentioned a minute ago you're concerned about the dollar valuation. Another question is how can, the dollar's been staying strong, money's been flowing into our country, it seems, because as I've said before, we are the kind of sort of the cleanest dirty shirt in the world's economic hamper, so it seems, at least on the surface. But what happens now while the rest of the world is easing and we're tightening? How does that affect the dollar?
Well, it's more about perception. Everybody believes that we're going to be tightening while the rest of the world eases. And it's those perceptions that have driven the dollar rally. But the perceptions are wrong. What's actually going to happen is we're going to be easing again while the rest of the world is tightening. You see, normally when the Fed raises interest rates for the first time, right, it's as a recovery is just getting underway. But this time the Fed has waited so long that the recovery is almost over.
Yeah.
In fact, I think by 2016, we're going to be in a recession again. And so rather than the Fed continuing to raise interest rates, I think they're going to do another round of quantitative easing. We're going to do QE4. It might be the European Central Bank that ends up raising rates before we do and ending their program just as our quantitative easing program is getting started. And remember, all that flow of foreign money into the U.S., it didn't go into building factories in America. It went into speculating in financial assets, stocks and bonds.
Debt, sure.
And it went into finance consumption. If you look at our trade deficits, they've been growing dramatically recently, just as our manufacturing and production have been declining. So all this hot money is going to leave even more quickly than it came. And I think the real threat is going to be a collapse in the value of the dollar that is going to send consumer prices much, much higher and put the Fed in a real conundrum because inflation is going to be well north of its 2% target, yet it's not going to raise rates because the economy is going to be back in recession and they're going to be fighting that.
Well, that was one of the next questions I was going to ask you then. If you feel as though inflation will be well over 2%, clearly you're not in the deflation camp. You're thinking more if our currency gets devalued, we have hyperinflation. Do you believe that the CPI index is or is not an accurate reflector of the inflation that your average income generation citizen is experiencing?
No, I don't think it accurately reflects it at all, and I think that's deliberate. That's by design. See, the government came up with the formula for measuring inflation, and obviously they want a low number, right? If you hired the mafia, to do a survey on crime, right? They're not going to come out and say, oh, there's a lot of crime, we need more police, right? They're going to come out and say, hey, you know, everything is great. Or if you know, if a child is going to grade their own report card, you know, you wouldn't be surprised if they had straight A's. So this is what's going on, right? We put the government in charge of reporting on inflation. And it's not that they fudge the numbers. They don't like get a number and then, you know, just make it lower. It's the methodology that they use to calculate the CPI has been changed so dramatically over the years that now it's almost impossible for that number to ever be high. Yet the government relies on that number supposedly as proof that they can keep printing money because it's having no effect on prices. But meanwhile, the average American feels the effects of inflation when he goes to the grocery store, when he pays his electric bill, you know, when he pays his rent.
Everyday expenses for our viewers. I get that.
And look at health insurance. Look at education costs.
We need to take a quick break, but we're going to be right back. And when we come back, we're going to ask what Peter thinks is the big surprise. We'll talk more about inflation, but we'll ask him what he thinks the biggest surprise is in 2016 that we might just not be expecting. So stay right here. We'll be right back. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We're here with world-renowned economist Peter Schiff. Peter, I apologize. Before the break, I had to cut you a little bit short. You didn't see because our producer was behind you waving his arms saying we have to take a commercial break and keep our advertisers happy. So continue talking a little bit about inflation and what you were saying about how the government measures it versus how our average viewer feels inflation.
Well, first of all, you have to remember that inflation is not a rise in prices. That is the result of inflation. The inflation is the expansion of the money supply. That's literally what's being inflated. And of course, we all know that money supply has grown dramatically. The Fed's balance sheet is now $4.5 trillion. So all that inflation has already been created. And it affects prices in different ways. Sometimes inflation shows up in financial assets before it shows up in consumer goods.
So what's going to happen?
Yes, we see it in real estate, we see it in bonds, we see it in stocks, we see it in, you know, collectibles, you know, rare art, antique cars, all sorts of things have been bid up with all the inflation, all the new money that the Federal Reserve has created.
Sure.
But consumer prices are rising, and I think they are rising faster than the government measures show. And the government doesn't want to acknowledge how fast prices are rising because then it would have to be much tighter in its monetary policy, but it doesn't want to do that.
Not to mention the fact that it has to give bigger cost of living raises to people receiving Social Security, people receiving government pensions, and all that.
So that just drives up the deficit.
Like the wolf guarding the hen house.
And also, if the government were to accurately report inflation, it would be obvious that the economy was growing more slowly or in fact has been in a continuous recession for the entirety of this supposed recovery. And in fact, that's why the recovery is so weak, because it doesn't really exist. I mean, if you look at the collapse in full-time employment over this recovery, if you look at the collapse in real incomes and household net worth, we've never seen a recovery where people were poorer at the end of the recovery than they were at the beginning of the recovery. This recovery looks more like a recession. And maybe because it is, because the government is not being honest in the way it reports the inflation numbers.
It's interesting. I mean, do you think that quantitative easing at all was a good idea, the TARP program? Or
No.
Do you think none of it should have existed, even the TARP program?
They were horrible ideas. What they did is they bought some time, but it was going to be very expensive. We postponed the pain, but in so doing, now the pain is going to be much worse because the problems have gotten much worse during the years that we've postponed the pain. But of course, all of the programs, quantitative easing, 0% interest rates, that was only supposedly necessary because the Fed inflated the housing bubble in the first place. So it's like the Federal Reserve lit the fire, and now we're trying to give them credit for putting it out without blaming them for lighting it in the first place.
The fireman who's an arsonist.
But they didn't actually put it out. It's just it just looks like it's out. It's going to come back larger than ever.
I can't argue with anything you just said. That's why it's such a pleasure having you here today. So since our commercial break, our viewers have been waiting with bated breath, waiting to hear what predictions Peter Schiff has for 2016. Things that, not things that are obvious, but things that maybe people might not be looking toward.
Well, a lot of things could go wrong in 2016 based on the perception of the markets. I think people are going to be surprised by the about face in Fed policy. For the last several years, everybody has been looking forward to the Fed tightening, and I think they're going to reverse course, and now they're going to be talking about easing. Maybe they'll start doing it, or maybe they'll just be hinting at it. Maybe they'll
in 2016.
Yes, and maybe they'll even launch QE4. Remember, it is an election year, and the last thing that Janet Yellen wants is voters going to the polls in a recession, at least in an official recession. I think Janet Yellen is very partisan, and I think she probably views herself as part of the Obama administration, just like Ben Bernanke thought he was part of the Bush administration, and then the Obama administration. So I think she's a team player. She wants to keep her team on the field. She wants to see Hillary Clinton elected, and she believes that the Fed can achieve that by printing money and buying government bonds, and I think that's what they're going to do. So we could potentially see some big reversals in all of the trades that were meant to profit from the Fed tightening. That would be the dollar reversing course and going down, gold reversing course and going up, as it really becomes a buy the rumor, not even sell the fact, but sell the fact that the fact didn't live up to the hype of the rumor.
Of course. So your reversal from tightening to easing all in 2016. Now, in addition to that, is it my imagination, or does it seem like the Federal Reserve today is worried, maybe inappropriately, about what Wall Street thinks of its decisions?
It's inappropriate, but that's what they do.
Yeah.
Because, remember, this recovery is all about Wall Street. It's not about Main Street, right? The Fed is trying to prop up the stock market, prop up the bond market. So obviously it has to pay attention to Wall Street, because that's the beneficiary of these policies. And of course, if the stock market crashes and the bond market crashes, we're right back where we started, because this was a financial crisis. It started on Wall Street. It was the collapse in the mortgage market, right? That's where it all began. So that is what the Fed has been concentrating on. But instead, it should have looked at Wall Street as a symptom of a greater problem on Main Street, having to do with the structure of our economy, where there's too much borrowing, right? Too much consumption, not enough savings, not enough production. But instead of addressing the root cause of the problem, they tried to cover up the symptoms, and that's why the problem is so much worse now.
Okay. Well, you heard it right here. World-renowned economist Peter Schiff is predicting a trend reversal in 2016 from tightening to easing, saying that the Fed is really watching lagging indicators instead of leading indicators, and I couldn't agree with that more. Peter, thanks so much for being on the show.
Yeah, my pleasure.
Hey. And right after the break, we're going to be back with Marty Johnson. As you know, always an informative news report. Stay right here. We'll be right back. This is fun. This is great. 3, 2, 1. I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. That's a great question, Marty. Well, if you don't have access to a time machine, you could take your chances and maybe, just maybe, get lucky. Or perhaps suffer a 50% loss or more. And then maybe have to wait as long as 6 or 7 years just to get back to break even, like happened after the drop that began in 2000 and the second one that began in 2007. And there's no one saying that next time it couldn't take 10 years to come back. If you're crossing your fingers hoping for growth and that doesn't sound like a good plan to you, you can do what I suggest to my clients. I call it the bird in the hand approach. Here's some background. The income generation has experienced firsthand the 1980s and the 1990s, which were incredibly good years for the stock market. Unlike retirees who lived through the Depression, I found those retiring today still view double-digit annual growth in the market as having a realistic possibility of returning. The reason many believe this to be true is because I find that it's our earliest experiences, almost anywhere in our life, that tend to shape our paradigms. Most of the income generation got serious about their retirement investments in the 80s or 90s, the best stock market in U.S. history. Think about your own track record as an investor. Your initial paradigm simply became, if I want to earn more return, I just need to take more risk. And although that strategy worked well almost until the year 2000, it clearly has not worked so well since then. This is an ailment that many income generation members refer to as being stuck in the 1990s mentally with their money. Obviously, this doesn't reflect the market's long-term average returns, which have indeed been much lower than we saw during that 2-decade period. This is why I caution anyone who does not want to outlive their savings, especially those who have a large percentage in stocks or stock mutual funds. And I hope that none of you wait with your fingers crossed, hoping for the go-go 90s to return. Now, getting back to Marty's question, what's considered a sound investment strategy if you don't want or you cannot have a roller coaster portfolio? Well, first, be honest about the purpose for your savings. Now, this may seem obvious, but stockbrokers' rule of thumb often stresses that more than half of your portfolio should be kept in stocks. The rationale is that over the long run, stocks create a great inflation hedge. Well, let me ask you, does zero growth sound like a great inflation hedge for a 20-year period? I say not. And most people of the income generation find that this percent simply doesn't fit their intended purpose of their money, which is to get income either now or in the near future, not growth. Investing for growth is at a very young age for the future. However, today, investing for income can allow income generationers to receive interest payments regularly without having to spend principal. That's why I call it the bird in the hand approach. Sound Income Strategy specializes in developing income-based strategies, and this specialty is not as common as I'd like it to be. Did you know that many financial advisors who specialize in stocks and mutual funds tend to think of income-producing investments only as an afterthought? These advisors often use bond mutual funds instead of a portfolio of individual bonds for their clients. As most of our regular viewers know, we discuss the difference between bonds and bond funds often right here on the show. In many ways, bond funds can actually be riskier than a diversified portfolio of individual bonds. With individual bonds, you have a much more predictable interest and principal repayment schedule. The benefit of investing for income is that not only are income-based investments generally less volatile than common stocks and stock mutual funds, but also when they do decline in value, even if it is to a lesser degree, for most, the income generated from these investments stays the same. This should be important to income generation members whose intended purpose is income and cash flow, not growth. So what types of securities might you find in a well-balanced income-producing portfolio? Depending upon your needs, there are a number of alternatives. Generally speaking, it might include investment-grade corporate bonds, mid-grade corporate bonds, municipals, preferreds, or possibly even BDCs or REITs, that when taken together in a portfolio, or at times individually, may produce the income that we're discussing. It isn't until you sit down with a financial advisor who knows your particular situation, but one that also is an expert in these income-generating approaches. Only then will you get a complete answer. For more help on this, sign up for our free special report at the end of the show. Then you can focus on something other than stock market movement. After all, I know people, I'm sure you do too, whose whole mood depends on how the market does. If the market ends the day on a high note, they're in a good mood. If it ends a day on a down note, they're in a bad mood. I advise that they invest in a way where they should be able to have far fewer surprises. I want to thank Peter Schiff for joining us today. He clearly doesn't think the Fed has a good deal of room to push interest rates upward. If you're a regular viewer, you know I agree with that line of thinking. But time will tell. Marty Johnson, your report, as always, opens our eyes and our minds to the less spoken realities of financial markets. We look forward to your joining us again next Sunday. For you at home, never forget, your financial advisor does not have a time machine. They're not able to know exactly how their stock market recommendations will behave and don't have a crystal ball to steer you away from trouble. Do not let them pretend otherwise. Instead, make sure you're putting probabilities on your side and keeping the risk in line with your goals. This is just good common sense. If you remember, it was Harry Dent who said on a previous show that it's easier for him to forecast what will happen 20 years out than what will happen next month. So unless your time frame is decades and decades before you need to touch your money, please consider income-based investments. One thing that is predictable is tax season, and that season is here once again. Here's some advice you can use very soon. As you collect your financial papers and your statements this year in preparation for tax season, take a look at your investment holdings, those holdings in IRAs, 401ks, as well as other savings and investments. The question is, are you invested for growth, although you're a member of the income generation? If you are, is it okay that you may experience a large cyclical loss that could take 6 or 7 or maybe even 10 years to recover? And if you're not sure how you're invested, don't hesitate to find out so you can set yourself apart and set yourself on the path that best fits your needs. It's not uncommon for me to find that the income generation, those 50 years and over, have a greater allocation to stocks than income-generating securities. None of us can be certain about the future, but we've seen how bad this mix can turn out. Have you picked up your special report written just for the income generation? It's a great thought-provoking and informative read. All free to you, my loyal audience. If you're near or in retirement, head over to theincomegeneration.com and get your helpful report now. I'm David Scranton, and you have been watching The Income Generation. We'll see you next Sunday.